Hey everyone, Paul Clark here, and in this video I want to walk through Asana, ticker ASAN. I also want to talk about how I came to discover this stock. So my girlfriend currently works as a virtual assistant, and I noticed that she had been talking about using Asana to be able to manage her workflow, and it's something that her teams use. And so when I heard that Asana was going public, I was like, okay, this is something she's using. There's some familiarity with it. It's going public. Is this a good stock that I would want to invest in? Because I'm a big proponent of saying that you should want to invest in things that you're using in your everyday life. So with that in mind, I was like, okay, she's using Asana. It's public. I want to take a look at that. And, right off the bat, so I follow a lot of different, financial commentators out there, so Jim Cramer, I noticed that, he was actually kind of negative on the stock, positive on the industry, saying, hey, the actual, when you look at, team collaboration and being able to manage that workflow and schedule tasks, that industry is growing. In fact, some estimates are by the year 2023, that industry is going to, in total, be generating revenue of about $32 billion. So certainly, some room for some strong growth. But at the same time, he was pretty negative about it, saying that it was kind of overpriced relative to what it was currently, and overpriced thinking about it because, yes, it's a big pie, but there are a lot of competitors out there. So it's not just Asana helping teams work better together. You look at it, there's a company called Trello, there's ClickUp, there's Monday, Slack, another one. So many competitors out there that are vying for that piece of the pie there, that you kind of start to wonder if any one competitor is going to be able to establish that foothold. So when I walk through the valuation on this, I want to kind of model out the growth rate assumed for the first year, for the second year, and then we're going to go ahead and take a look at the growth rate we're going to assume kind of in a steady state, from year 3 through year 10. And what I ultimately want to do is say, hey, when we're looking at this stock in 2030, what would it take? How big would they have to be to justify the current stock price? And then we can kind of work backwards and understand if that makes sense to us, if we think that those are too aggressive. I think that's a good approach. And the model that I put together, it's dynamic. So again, we'll be able to change the inputs and be able to see how that affects the model. And we're going to be doing this based on modeling out revenue, because Asana is actually not currently profitable. I mean, if you look at Asana, they've actually been around since 2008, and they've posted a net loss every single year since they were founded. When you also take a look at who they were founded by, I feel like that's a pretty interesting story. So it was Dustin Maskovitz. He was the roommate to Zuckerberg at Harvard. He was able to make a ton of money from his involvement with Facebook. But when he left Facebook, he wanted to kind of go his own way, created Asana, and now he's taken this company public, and it's worth billions of dollars. So I mean, that to me is pretty wild. I mean, maybe I've just got too simple of a mind, but when you think about two roommates both going on to found companies that are now independently worth billions of dollars. So with all of this in mind, let's go ahead and get into the model. We'll walk through kind of some different scenarios and find out what would have to happen to justify the current price, and if I think this is a good investment. So let's get into it. Okay, so let's get into this model I put together to try to anticipate what the value of Asana could be. So when we look at this, I'm going to start out up here in the upper left-hand corner, and we're going to take a look at the current share price. So it's currently trading at $23.98, and that's where it ended on 10/16 at the closing price there. And with the total shares outstanding of 155 million, because this data, all by the way, except for the per share information, is in millions. But when we look at the market cap, based on the 155 shares that are outstanding, we see that it has a market cap of $3.7 billion. Now, this I think is a really important point, is that when you look at the shares that are authorized, this company, Asana, is authorized to actually issue 691 million total shares. And they've already seen a big increase in the shares that are outstanding. The 155 million that are outstanding today is about double what they had from a year ago. So you're already starting to see shares increase. And why does that happen with a company like this? Well, Asana is a company that's growing very fast in terms of revenue. They're growing fast in terms of user acquisition, but they are continuing to lose money. When you look, in fact, Asana was founded in 2008. They have posted a net loss every single year since 2008. So they've been losing money. But at the same time, again, their revenue growth has been really, really strong. So in order to continue to fund that expansion, they're going to have to rely on issuing more shares to be able to take in more equity value from that. So the company will be able to fund their operations. They certainly can fund it with debt as well, but that's part of the reason why the shares are increasing. And personally, I get a little nervous because when I see a document that says that the company is authorized to issue the $691 million. I know that doesn't mean that it's inevitable that they will take full advantage of that, but just the fact that they could if they wanted to, and that coupled with the fact that this company has already, observed and realized, several consecutive years of a net loss and has never made a profit yet, that has me concerned. And then we come over here to the revenue that this company has generated. So again, this is a multi-billion-dollar company, and these are all in millions as well, except for the percentages, of course. But when we look at this being valued at $3.7 billion, and we look at what the revenue had for the full year ending on January 1st, 2019, this company had revenue of $77 million. Okay, so $77 million for a full year of sales. And then market cap is currently at 3.7 billion. That's a pretty big disconnect. And then we look at, for what it was in the year ended January 1st, 2020. So again, this is a full 12 months of information here. And we look at that revenue, and it increased by close to 86% to 143 million. Their gross profit was pretty strong, but again, in terms of their net loss for both of those years combined, they had lost 170 million dollars. And again, I mean, that's pretty substantial, and there's really no clear path for them to get to profitability at this point. So again, that remains a concern. So because this company isn't currently profitable, and because this is a company that is based on the premise is that they're going to be growing quite rapidly, and that they participate in a market that is considered to be quite large and growing. Again, I think we had already kind of talked about the fact that by 2023, it's estimated that this total market that Asana plays in could be worth revenue of a combined $32 billion. So certainly a big sandbox, but again, a lot of competitors at the same time. So modeling out their revenue, I've got some inputs here, and these inputs for the year 1, year 2, and then the years 3 through 10 growth, those are going to change the information that we're seeing in this here. So when we look at our revenue and our year-over-year growth, forecasting that over 2030, changing these are going to change the information right in here. And then once we figure out what our ending revenue is going to be in 2030, we're then going to be able to put in what we think the market is going to value that at. So we think the price of sales is going to be, worth 8 times what they're selling in 2030. And then we can go ahead and project out what their market cap is. And once we know what the market cap is, we can kind of make some assumptions about how many shares are outstanding in 2030. And then we can start doing some math on what has to happen for this stock to be a buy today. Okay, so right off the bat, again, knowing the fact that this company most recently for their full year reporting increased growth of 86%, I wanted to say that, for the first year that we're going to be projecting, so projecting full year 2020 revenue, we're going to assume that this company is going to be able to generate 70% year-over-year growth. And then we're going to say that after that, they're going to be able to generate 50% growth, and then they're going to start to kind of normalize a little bit to 35% growth. Now, keep in mind that, when we talk about, hey, it's going to come down to 35% year over year in years 3 through 10, that's still really aggressive. And again, I mean, with a company like Asana, knowing that they're currently losing money, currently knowing that there could be competitors out there lurking that, are in the process of, being created that could be a competitive threat to Asana, there's certainly a lot to be concerned about. So it is nowhere clear that they're going to be able to achieve this growth. But here's the really interesting thing. So, and I've got this here. So we see 22x. This 22x is saying that from 2020 to 2030, this would imply, based on all of these numbers, that the revenue would increase by 22 times. Okay. And even if that happens, let's see what happens to the share price. Let's walk through this. So we come down here and we see I've got 3 different scenarios listed out. So first of all, we've got the market cap. And as we already discussed, the market cap is just going to be the 2030 ending revenue. So in this case, it's currently set up modeling about $5.4 billion in revenue. And if we assume that the market's going to say that they're going to value that at 8 times sales, then you'd be looking at 5.4 times 8 gets you to about $43 billion in value for the company. Now, the three scenarios are based on what happens with the shares outstanding. So let's say for some reason that Asana doesn't actually need to issue more shares. The company kind of just is able to do just fine with the current shares outstanding. Well, that would mean that if we divided that market cap by the current number of shares, the 155 million that are outstanding, you would get to a value per share of $280. That's what it would be in 2030. Okay, so what if, on the other hand, they actually, they took advantage of the fully authorized amount of shares that they can put out there. So they have 691 million shares at 2030. Well, in that particular case, when you divide out that market cap, then that would imply that in 2030 their share price would be $62.69. And, kind of maybe like a little bit more of like a happy middle ground might say, hey, what if they don't fully dilute the stock by the fully authorized amount, but what if they issue half of that 691 million? What would the share price be then? And in that particular case, it would be a little over $125. Now, these are all based on $2,030, okay? And what we have to do is understand, of course, being in 2020, we want to discount that back. So when we discount that back to $2,020, I'm going to be assuming a discount rate of 10%. And I think, 10%, might even be on a little bit of the lower end, or a fairly conservative number when you're discounting, some revenue back, or discounting value back for a company that, might be as volatile or as risky as Asana. So keep in mind that even that discount rate is a relatively conservative number to be using. So we're discounting that back. And at the same time, when we take a look at the market cap, so $43 billion discounted back, to $20 would be about $18 billion today's value. And then if we say, okay, well, what if we divide that discounted market cap by the current number of shares, it'd be $118, and that would imply a 395% increase from where the share price currently is at $23.98. But again, we already kind of talked about it's pretty unlikely that they're going to have the current number of shares outstanding in 2030 is what they have today. So if they were fully diluted to what the company is authorized to be at, then that would mean that this company would be worth, on a discounted basis, $26.59. Now, at least and that's the current assumptions, of course, of pretty aggressive growth, and that would imply about an 11% increase from the current value. So I mean, to me, there's really nothing there that in 2030, if you're going to say that you're going to have an 11% return for the next, 10 years in total, I mean, that looks, pretty horrible. So certainly if that's the case and they have that full dilution, I really wouldn't want to participate in this company. And then again, even in this case here, if they were to just dilute it by half, that would imply 122% upside. Now, again, when we look at this, that's also assuming a 35% growth. That's assuming that they're going to be 22 times the size in 2030 as what they are today. What if, we were to say that it was actually going to grow in years 3 through 10 by 30%? Okay, well, all of a sudden we see like how sensitive that was. We now all of a sudden go in scenario 2 where if they're fully diluted, that the share price would actually be worth about $19 or 21% less than what it currently already is trading for. Okay, and then on the flip side, we say, okay, well, what about the half diluted? We'd say that'd be 58% upside. And we can kind of even, take that down further. What if it was actually going to be a 25% growth rate? Well, then all of a sudden fully diluted means that you'd be losing about half the value in 2030 versus where it's currently trading at. And then 25% growth would actually say if they just issued half the shares like we've been talking about instead of the full dilution, that would imply 11% upside. Now, one of the things, again, with a company like this, when you're starting to say that you need this company to be growing by 35 or 40% for this to kind of make sense, assuming that they have that full dilution, I start to get pretty concerned because, there's a lot of what ifs. There's a lot of things that they need to go really right for this company. And for that reason, this is not something that I would want to invest in. I think that, this kind of gets back to the Buffett mentality. You look at how Warren Buffett invests. He wants to invest in companies that have more stable cash flow, because if you have more stable cash flow projections, you have a better kind of safety net about what you think they're going to be able to generate in the next 5 or 10 years versus looking at a really high growth company that has a lot of risk like Asana. So again, this is why Warren Buffett would invest more in a Kraft Heinz. This is why he would invest in a Coca-Cola as opposed to a company like this. But regardless, even if you were going to be investing in this company, I think by far the biggest thing is to understand what has to happen in terms of their growth rate, what would have to happen in terms of their how many shares would be issued. I think it's just so important to kind of be aware of these things. Because you might, on the flip side, you might be really optimistic and you might say, hey, I think they're actually going to, in the next year, they're going to double their sales. I think that they've got this momentum, and now that they're public, I think that they're going to double their sales. And let's say in year 2, you think it's going to then grow by 80%, and then years 3 through 10, it's going to keep growing by 50%. Well, if those are the kind of the assumptions that you're making, well, then all of a sudden you're going to say, okay, in 2030, you'd be looking at this stock, even on a fully diluted basis, they'd be worth $96.89. I'm not saying that by any means that these are realistic targets. And again, saying that they're going to double in the next year in terms of the revenue, and then they're going to grow in a steady state for the next 3 to 10 years by 50%. I mean, that would imply that they would be worth, in terms of their revenue, 69 times more than what the 2020 projected revenue is. I don't personally see that as the path, but I think that if you wanted to invest in this, and if you think, hey, I'm going to buy this, and I think that it's going to go from $23.98 and it's going to run all the way up to close to $100 a share, it's good to know what needs to happen to hit that metric. So anyway, that's kind of my takeaway from Asana. This is why I'm not currently investing in this. So I've got to say that, hey, sometimes I agree with them, sometimes I don't, but I think Jim Cramer said it right, that I think that Asana at these prices is just too expensive for investors to kind of make any kind of money with this over the next 5 or 10 years. So, hey, thanks for watching. It's been a lot of fun putting this together. And again, as always, let me know what you think in the comments below.